So what is a stock exchange? And why does everyone who knows how they operate appear to be rich? Well, this is something that's vital for anyone who has an interest in investing. A stock exchange is a marketplace where stocks, bonds, and other securities are bought and sold. It's a vibrant, dynamic platform that brings together buyers and sellers, facilitating the exchange of ownership of companies. And typically, the more you know and get involved, the richer you'll become over time. In this video, I'm going to tell you how it all works, some key terminology, and what you'll need to do to have a foundation in securities. So first off, stocks are called securities because they're secure contracts that are tradable on financial markets. But stocks are more than just markets. They provide companies with a valuable way to raise capital, encourage investors and companies to be open and transparent, and help the public as a whole to understand the value of their investments. In the past, stock exchanges were physical places, like the New York Stock Exchange trading floor. But today, the overwhelming majority of stock exchanges handle all trading electronically. Not just anyone can show up at a stock exchange and buy shares, however. Trading is handled by brokers and dealers that meet strict stock exchange membership requirements. Likewise, not just any company can trade on a stock exchange. To be listed or traded on an exchange, a company must satisfy certain minimum standards, like being registered with the U.S. Securities and Exchange Commission, the SEC, having a minimum number of shareholders and shares outstanding, plus a range of other qualifications. They're like a grand stage where buyers and sellers perform their trading dance, exchanging stocks with ease. But that's not all. They also serve as launch pads, helping companies jet off into the financial stratosphere with their initial public offerings, or IPOs. There can be a lot of excitement when a company goes public, but invest with caution. Companies that are newly public often struggle to maintain their success or grow, and some even go out of business. That makes recent IPOs a very risky investment. Moreover, they're the guardians of transparency and fairness, ensuring each transaction is above board. Now, this is something you need to know. What are the different roles required to facilitate the sale of securities? Brokers. First, we have brokers, of course. A broker is an individual or firm that represents the interests of outside investors at a stock exchange. Because only members of a stock exchange are allowed to buy and sell assets on it, brokers act as agents who find buyers and sellers to fill orders for outsiders, like you. Brokers generally charge commissions or fees for their services, and some are employed by a stock exchange to help keep things moving. Dealers. Next, we have dealers. A dealer is a firm or an individual that buys and sells securities for themselves. A dealer always aims to profit from the difference between the prices it can buy and sell securities at. In other words, they aim to buy a stock at a certain price, not because they anticipate holding it for the long term, but because they think they'll be able to turn around and sell it for more than they paid. In this way, even though the dealer does not represent exchange outsiders, they may end up helping and directly facilitating trades with them in their pursuit of profit. Broker-dealers. The roles of a broker and a dealer are frequently combined into one firm called a broker-dealer. They buy and sell stocks on behalf of outside investors, and they also trade for their own benefit. Market makers. This role is filled by dealers who buy and sell stocks for their own benefit, specifically to increase the liquidity of a stock exchange as a whole. This added liquidity helps facilitate more efficient trading and ensure orderly markets. The New York Stock Exchange has a class of market makers and specialists that only trade in one or a few individual stocks. And how do these stock exchanges operate? Each trading day kicks off and wraps up the iconic opening and closing bells. During the day, orders are matched and stocks are priced based on the laws of supply and demand. Market makers play a key role in providing liquidity and keeping the market moving by buying and selling stocks. It's a complex process, rather fascinating, and it's all geared towards ensuring a fair and transparent trading environment. Trust and transparency are critical in the world of finance. They're the bedrock of any stock exchange. This is where regulatory bodies like the SEC come in. These watchdogs enforce rules, investigate potential violations, and slap penalties on those who step out of line. Measures are in place to prevent fraud, to protect investors, and to maintain the integrity of the markets. These regulations ensure that the stock exchange remains a trusted platform for investors. Now let's explore the shadowy corners that you're not aware of, the dark pools. These are alternative trading systems, or ATSs, where the trades occur away from the public eye. Unlike stock exchanges, they're less transparent, less regulated, offering a degree of anonymity. Designed for institutional investors, They allow large volumes of shares to be traded without affecting market price too much. An ATS, thus, offers a different avenue for trading away from the public eye. One thing is clear, stock exchanges with their hustle and bustle are pivotal to the grand theater of economics. They are indeed the backbone of the financial world. Hey, if you're looking to learn more about trading and investing, I have this awesome playlist right here called All About Stocks. And don't forget to hit that like button. I'd be forever grateful. Lots of love to you.